Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I'm joined by Andrew Tully, Technical Services Director at Nucleus Financial. Thank you for joining me today, Andy.
It's nice to be here.
So for those who may not know you, could you give us a brief introduction into yourself?
As you mentioned, I'm Technical Director at Nucleus. So I run a team of experts who help advise us with pensions, tax, trusts, ISAs, whatever, just helping them understand the legislation, regulation, what's changing, as many things are at the moment. And just helping them help clients in the best way possible.
Yeah. And there are quite a few things on the docket for pensions this year. But this particular episode, we want to focus on inheritance tax. So what are the key proposed changes to inheritance tax and what impact could they have on financial planning?
Okay, so the key change is the government is proposing that pensions will be included in the estate for IHT purposes, and that's from April 2027, so a couple of years away. That would obviously be a massive change from a current position where there's a very generous tax treatment of pensions on death. It's worth saying it is a consultation at the moment, so there is, a likelihood, at least, that it will change to some degree. How fundamentally it changes is to be seen. But yeah, it's worth saying it is a consultation at the moment. So worth bearing in mind when it comes to giving advice is it might be sensible to wait until we get a bit more clarity during the summer.
Right. And how is Nucleus contributing to the ongoing IHT consultation?
Okay, so when the government announced this or proposed it in the autumn budget, they launched an immediate consultation. So as a business, we've obviously responded to that consultation. We've also participated or worked with HMRC a variety of working groups and workshops over the last couple of months just to walk through the proposals. There's quite a big concern here around the practicalities of the change. So we're pulling together what's a very complex inheritance tax regime, and then pensions are obviously quite complex as well. And so we're bashing together two very complex areas together, and the worry is that makes it horribly, horribly difficult for people. So we've been working with them on that, and then we're working collectively now with other firms and industry bodies to discuss how we can work with HMRC, HMT going forward.
Mm-hmm. And what strategies should advisors consider to help their clients navigate potential IHT reforms?
So again, it's probably worth taking a step back and looking at if these proposals go ahead, it's not necessarily a good outcome for all. Obviously, both in terms of the tax situation, but also just in terms of the process and the way it works. So if we look at beneficiaries, people are often vulnerable. They've just lost a loved one in this situation. So advisors will be trying to help them through that position, as will firms. People might need access to cash quite quickly, so they might have a funeral to pay for. They might be worried about the long-term financial situation because they've lost a partner. So there's lots of issues there, and given these proposals, the likelihood is there's going to be delays to payment. So pension schemes will pay out pension death benefits slower once this new regime is in place than they do today, and that's obviously not a good outcome for beneficiaries. the way the IHT regime works, it might mean there's more late payment penalties take place, so people effectively receive less money because more penalties have gone to HMRC. We've also got personal representatives involved. They will often be a family member, so again, lost a loved one. They could be solicitors in some situations, but we're making their job more complex, so they're already dealing with the other estate, so the house, the investments, the ISAs, and we will be throwing in what can be quite sizable pension assets into that situation for them also to deal with. And they won't generally be pension experts, so they won't really understand pensions. So we're increasing the difficulty level and the work required for personal representatives, and they also will have a role to apportion the nil rate band. So we'll need to split the nil rate band up between the various pensions and the remainder of the estate. So we're giving them more work to do. And then if you look at firms and advisors, this is likely to be more complex, more time consuming. And then HMRC themselves are likely to get money slower than they would have done previously. So as a kind of concept, it seems lots of trouble for lots of people, if that makes sense. So I'm sure advisors are getting lots of questions about that. As I mentioned, I think it is worth waiting. We will get more clarity in the summer. So I think in a lot of situations, we'll still be 18 months out from introduction at that point in time. Still time to plan. Pensions remain free of inheritance tax up to 2027. So today they are still the best place for money to be generally. But there will be some situations, some specific situations where advisors will want to do some planning. That might be, people who are above 75 looking to take tax-free cash out and get it out of the pension so that you don't pay income tax and IHT. It could be older people who've got very sizable pots and they want to begin planning now just because they need some additional time. So I think delaying for some people will make sense, but equally accept that advisors might want to do some work, at least preparation work now. So.
Right. And in your opinion, what is the likelihood of these proposed reforms happening the way that they have been stated so far?
So I would imagine there'll be changes. I think most consultations, particularly one, as I say, around something this complicated, I would be surprised if there wasn't changes. I think what you're really asking is there a much more fundamental change? Is there a likelihood that we don't put pensions within an IHT environment? Yeah. And I think that's less likely. I think if the government had said at the outset, we want to impose a tax charge on wealthy people leaving money to the next generation, I think there would then be a debate around, do you do it through IHT, or are there alternative options like income tax or like a one-off charge that might actually be much simpler and much easier? And they would be much simpler and much easier. However, that wasn't what government did. The government said this will be inheritance tax. So even if we can demonstrate to them that they can raise similar amounts of tax in an alternative, it would still involve a political decision to reverse an announced proposal. And I think that politically that can be difficult to do because it will be portrayed by opposition parties as a U-turn. So not massively optimistic for a fundamental change. That doesn't mean we won't keep suggesting and proposing alternatives, because we will. Tweaks and changes to the process and hopefully simplifying the process, yes, I think we can definitely get some of those through.
Mm-hmm. Are there specific client groups who will be most affected by these proposed changes?
So I think to answer that one, I might turn it on its head slightly and talk about who won't be affected. So currently only around 4% of estates pay inheritance tax. That is increasing over time, but at the moment it's about 4%. The government are suggesting about an additional 1.5% of estates will be pulled in because of this measure that previously weren't liable to IHT. So this is a minority of people. If and you can argue about is 1.5 right or not, but whatever figure you put on it, it is a minority of people who will be affected. Having said that, advised clients, it'll be a much higher proportion of advised clients because advised clients tend to be wealthier, isn't it? So advisors listening, they will say that that's not, but over the population as a whole, it's a relatively small number. And we also have to bear in mind that anything going to a spouse or a civil partner is passed on free of inheritance tax. So the same as any other assets, a pension will be able to be passed to a spouse or civil partner. It won't be subject to inheritance tax. So that will take another bunch of people out of scope. At least on the first death, we could store up a situation. So, if I died and I leave it to my wife in that situation, there's no IHT at that point in time. However, potential her estate is much bigger, and so when she dies, there could be an IHT situation on her death. So while there might not be IHT on first death into spouse transfers, we could store up a problem on second death. So there's still advice implications to take part in that. But yeah, I mean, it has got lots of focus in the industry, and rightly so, because it's a big issue. But again, worth bearing in mind, it's a minority of clients who will be impacted.
Right. And what common IHT planning mistakes have you witnessed or have you heard of that other advisors should avoid when helping their clients?
Yeah, I think the big one that for clients who weren't taking advice, I think the obvious, they will read about it in the papers, and the papers will say big IHT charge if you leave your money in pensions, and so there might be a desire to get that money out and do something with it. So again, bearing in mind it won't affect all people, so advisors will be able to help people understand, will it impact them or not, but also what to do with that money, because there's no point taking the money out of a pension and just sticking it in a bank account. And that's a little bit flippant, but a customer who wasn't getting advice, they might read, pensions are bad, let's get it out of the pensions, put it in an ISA. Well, an ISA is still part of your estate for IHT purposes. So it's crucial about what you do with it once you get it out of the pension, and that is basically you spend it. And to be honest, if people wanted to spend it, they would probably already be taking it out. So you give it away. And that's certainly where advisors can help people in terms of gifting, or you shelter it, and that might be using trusts or something like that. So I think that the big area that advisors to help clients is working out if this impacts them in the first place. But the key is what strategies to undertake to make sure that people still get a retirement income for the remainder of their life, which is the kind of key fundamental here, but also that they are passing on any wealth as tax efficiently as possible.
Right. And how might trusts and gifting strategies evolve in response to these proposed reforms?
So I think gifting is probably a huge area that's probably been underused to some degree. And that's because, in a way, pensions was a very simple mechanism. What we've seen over the last 10 years to a huge degree since pension freedoms is, as a retirement strategy, probably use pensions last. So take money out of other assets, ISAs and so on, to fund early retirement. Begin maybe to take a little bit out of pensions, in the knowledge that if there was anything left in that pension pot, it was passed on very tax efficiently. And that's been quite a simple strategy to use. So if these changes come forward, that we'll have to amend that strategy to some degree. For many people, retirement income is still the fundamental aim of the pension, so that's the first focus. But the passing on wealth is still a key priority. So it's it's helping people use that money, and gifting becomes a key part of that. So, and there's some quite straightforward gifting opportunities that get the money out of the estate quite quickly, immediately in some cases. So you can give £3,000 away to anyone each year. If you're in a couple, that means you can give 6,000 away each year. And so it's almost people getting in the habit of using that each and every year and getting money out. Over and above that, you can give £250 to as many people as you want. So you could give, if you've got 10 grandkids, you could give £250 to all of them. That's £2,500 outside of your estate every year. And again, each person in a couple could do that on top of the 3,000, as long as it's not going to the same people. You can give one-off gifts on marriage. And probably the biggest one, which is underused, is what's called gifts out of normal expenditure, which is quite a complex one. HMRC have written down, as little as humanly possible, I think, about gifts out of normal expenditure, because they quite like being able to take each case on its merits. But fundamentally, it's about doing a pattern of gifts. So you have to do it over multiple years, probably at least 3 or 4 years. And it's surplus income. So it's all of your income added up, all of your expenditure added up. Do you have some money left over? If you do, you can effectively give that away. And as long as you do that on a regular basis, that can be immediately outside of your estate for IHT purposes. So again, a key opportunity to get money out. The record keeping is hugely important around that. It's not only record keeping around the number side, but keeping records of what the client intentions are, just in case it is challenged by HMRC at a later date, because they'll kind of look at it retrospectively. So they'll look at it after death and kind of look back. So it's all about making sure that the paperwork and things is in place. And then not forgetting, we've got things like potential exempt transfers, which is you give a certain amount of money away as long as you can live 7 years. It's generally outside of your estate. So that comes back to inheritance tax planning being done as early as possible. And that's a difficult one, because none of us like to talk about dying, is it? It's not a fun topic, is it? It's but crucial for planning is to talk about it as early as possible. Very simple mathematics. If you start planning at 60, how many 7-year cycles can you fit in? You might be able to fit in, 4. So you could effectively give away money 7 years 4 times out of your estate. If you don't start planning to 82, you might have one bite at that cherry, but that's probably it. So the earlier you can do this, definitely the better. So that's all the kind of basic planning. And then after that, we'd move on to the use of trusts. And in that situation, that's definitely a situation for advice, because it comes down to what's the client's aims and intentions. Do they need access to the money? Do they need access to some of the money? So it comes down to lots of these things about what type of trust you would use. But you might be able to get some of the money, some of the growth out of the estate quite quickly. And then there would be a decision there for the trustees of that trust about where do they invest that funds, and that's where investment bonds can come in, because they are the non-income producing assets. So that means that the trustees don't need to be doing tax returns every year and things like that. So from a simplicity for the trustee point of view, using bonds as an investment for a trust can work. So and again, but advisors know about using bonds. It's not a new concept. So, but certainly at that end of the spectrum, definitely a need for financial advice.
Mm-hmm. And finally, what's your top piece of advice for advisors navigating IHT changes in 2025?
I'd probably go back, at risk of repeating myself, I probably would go back. I think it's worth in many situations waiting and holding off for many clients until we get more clarity. And HMRC said we should get more details in the summer, and they'll come back with proposals and hopefully draft legislation at that place. So we'll have a much greater degree of certainty. And summer can mean lots of things to government, but hopefully that might mean July or something like that.
I was thinking it's going to be August, the month that's meant to be the quietest.
Wow, yeah, the time not to do stuff in August, so probably July or September, but you never can tell. But hopefully, let's say we get something in August, a lot more detail, a lot more certainty. You can start planning with certainty at that point. We've seen in the past trying to second guess what governments do can be difficult. People can make wrong decisions. So while there will undoubtedly be situations that advisors need to take this into account and need to give advice, I think for the majority, holding off till the summer would be a helpful, sensible outcome.
Yeah. Well, thank you for joining me in today's episode, Andy. You're always a wealth of knowledge.
Thank you.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.